Hello everyone. Good morning, good afternoon, depending on where you are in the globe. Welcome to the webinar. We're just going to give folks a few more seconds to join, and we're going to go ahead and get started. Thank you. Just a couple of more seconds. All right. Okay, sounds great. Let's go ahead and get started. We're extremely excited about this webinar. Welcome again to everyone. We're thrilled to have you join us from all around the world for this webinar in partnership with Standard Bank and an effort to create a platform to discuss the business case for investing in Africa and delve into the challenges and the solutions. We present the series of webinars titled Investing in Africa, the Time is Now. In this session, we're going to hear insights from trailblazing women fund managers, driving changes in African markets, and promoting and fostering women active participation is our priority, and Standard Bank's as well. So we hope that you get a valuable insight and get to ask questions so we can have a productive discussion. Allow me to introduce our wonderful moderator, Thembi Matabwiswana. She's a senior consultant at Rescura. Thembi brings a wealth of expertise in managing funds, research across a multitude of asset classes. These include global equities, Australian equities, fixed income, property securities, global emerging markets, New Zealand equities, and alternative investments. In her role as a senior consultant at Rescura, Thembi oversees the local clients, providing advisory services, research, and business development initiatives. Her previous experience includes working at Loansac, a stock bonding and research firm based in Melbourne, Australia. She has also worked in a leading bank, ANZ, as a managing funds research manager within the chief investment officer based in Sydney, Australia. Welcome to you all. Just another housekeeping note. If for our wonderful attendees, if you could put your Q&A question in the Q&A box underneath, and please, if you could wait until the end to post your questions so we can facilitate that and have the panelists answer your questions accordingly. I will now hand it over to Thembi. Thank you.
Thank you, Yepsira. Thank you for that warm welcome. Let me get straight into it and introduce our astute female fund manager panelists. We have Ms. Jessamine Faulkner-Pearl. She's the co-founder of AIH Capital. AIH Capital is a wholly Black, women-owned and managed South African private equity fund that is focused on the mid-market. Jessamine also serves on boards of the Johannesburg Stock Exchange listed firms such as Spur, Murray & Roberts, and the agri conglomerate ETG. She's also quite the academic, having created the online Udemy course dealing with the heart of race and gender inequality in the workplace. Jessamine was the former head of business engagement in Africa of the World Economic Forum. She was also honored as a young global leader by the World Economic Forum in 2013. And finally, Jessamine is a chartered accountant from South Africa and holds a master's degree from Harvard's University, JFK. We also have Ms. Sheila Kiarisima, a partner at NISC Capital, which is a boutique corporate finance and investment advisory firm, which has raised in excess of $1.5 billion across 6 countries in the past 9 years since its founding. Beyond her investment banking experience, she has corporate governance experience in commercial banking at the board level. Since 2019, she has served as an independent non-executive director on the board of CIB Kenya, a Kenyan subsidiary of Egypt's largest private bank, chairing various committees, including credit, audit, and HR. As a presidential appointee of the Kenya National Investment Council of Kenya, Sheila tackles issues pertaining to investment policy with the goal of growing, enhancing private investment as a key driver to delivering on Kenya's economic transformation agenda. She has also previously worked as an advisor to the CEO of the Rwanda Development Board, supporting the advancement of private sector investments as part of Rwanda's economic transformation agenda. She also holds an MBA from Harvard Business School, a master's in public administration from Harvard Kennedy School, and a Bachelor of Science in Civil Engineering from Brown University. Finally, on our panel, we have Ms. Deswa Okunbo Rhodes, a founding and managing partner of Arua Capital Management. She has over 15 years of experience in investment banking and private equity. Adesu has garnered numerous accolades, including being named an agent of impact by Impact Alpha, one of the top 35 women moving Africa forward in 2020, and one of the top 100 global leaders by Meaningful Business in 2021. She was recognized by the Institut Choiseul as a top 100 African leader under 40, both 2022 and 2023, and celebrated as one of the top 50 inspiring women in Nigeria by Business Day. In 2023, she won the 2X Global Award for Woman Fund Manager of the Year and was honored as one of the 150 Eco Aspire Women by the Lagos State Governor, among other distinctions. Notably, with Arua Capital's $20 million fund, she is the only female general partner in Nigeria to raise over 10 million in the first fund, highlighting her commitment to gender equality and economic growth in Africa. Arua is currently raising for Fund 2 and looking to double the size. Adesua holds a BSc in economics from the University of Bristol. She currently sits on several boards in Nigeria across healthcare, manufacturing, agriculture, renewable energy, and hospitality sectors. So with that, ladies and gentlemen, without further ado, let's get straight into it. My first question is for you, Adesua. Can you please give us your views on or shed some color on the investment strategies employed by Arua that have led to your success in fundraising and exits?
Thank you, Sembi, and thank you to Mida for having me. So I run Arua Capital Management, as you said. Thank you for that introduction. We are an early stage growth equity and gender lens fund. So we invest in proven businesses that are at a very critical point of inflection in terms of growth, and they need incremental growth capital to help them scale. So we help to bridge the gap between VC and private equity, where these earlier stage businesses have already proven their business model, but they need between $1 to $3 million of capital to scale. So they're typically deemed too small for the private equity funds, but are also deemed too late for the venture capital funds who are looking for kind of more early stage tech focused businesses. So in this segment, we think that it's where we invest in Nigeria and Ghana, this is a very attractive segment to be investing in because it's sufficiently de-risked, but there is significant equity upside and there's significant growth to come from these businesses. In addition, we use a gender lens to invest. So 100% of our investments are either female-founded, female-led, or could be male-founded or led, but have an essential good or service that they're catering to, that is improving the lives of women, or is catering to the female economy. We think that that segment is very untapped. There is significantly limited competition, where less than 2.5% of capital is currently going to female entrepreneurs in Africa, even though Africa has the highest rate of female entrepreneurship in the world. So we see it as a very strong arbitrage opportunity, where as one of the few women-owned and women-managed funds in Nigeria and across West Africa that is deploying a gender lens, we can show the trickle-down effect to female entrepreneurs in our portfolio. We can show the trickle-down effect to gender diversity in our portfolio. And this actually enhances profitability of our companies, because it's not just the founders. We have gender diversity across management teams, across the board, across the value chain, which helps to bring diverse thinking, which helps to bring, in our view, enhanced performance. So this enhanced profitability that we see in our portfolio companies has really been able to enhance the returns of our fund. So Arua Fund 1 today is a $20 million fund. We're backed by the likes of Visa Foundation, the likes of MasterCard Foundation, backed by FSD Africa, which is backed by the UK government. And Fund 1 today is outperforming global benchmarks in terms of financial returns. And in addition, because of the role that women play on the continent, investing in women is also a social impact multiplier. Because if you're able to empower a woman, she's typically spending 90% of her income on her family, access to education, access to healthcare for her children. So as you empower a woman, you empower a society, you empower a community, you empower a country. So if you care about the seamless intersection between profit and purpose, this early stage growth equity investment strategy that we have, combined with a gender lens, we believe is the best way to do it. So for us, we have now really proven and validated that strategy with Fund 1, and we're very excited to double down with our $40 to $50 million Fund 2 that we have also successfully launched. So for us, it's really about the segment of the ecosystem that we're focusing on, which we think is very attractive from a risk-adjusted basis, but also the gender lens strategy that we're deploying, where we see very, very clear arbitrage opportunities to close the funding gap for women.
Thanks, Adesua. And just on that point, what type of performance metrics can one expect? With your current fund 1, what type of returns are you seeing for your portfolio companies?
So we typically target at least 30% IRR or 3x invested capital. We are currently in year 5 of our investment period. So we're already kind of right at the end of Fund 1, where we have already deployed close to 80% of Fund 1. And I think something that's very attractive about our strategy is that we've already seen 7 partial exits from 10 investments that we've made. So we're very, very keen on showcasing early liquidity for our investors, because, in Africa, we are typically, with a 5-year cycle, there's a lot of things that can happen with the macro, economy in 5 years. So when we make investments, we're very, very keen to de-risk over time. So we've been able to have, significant liquidity events from our portfolio in less than 5 years. So I think for us, it's very, very important to be able to de-risk investments over time, whilst also not limiting our equity upside. So our returns are, I would say, are quite attractive. And that's just because we've been very, very intentional about being true to our strategy and being true to the segment of the market that we're focused
on. Thank you. And just still with you, what role does impact investing play in Arua's investment decisions? I know you touched on earlier, but maybe you can expand on some of the filters that you use and the outputs that you're looking for.
Sure. So we really strongly believe that financial returns and impact are not mutually exclusive, especially when you're investing in our markets. We believe that every investment has an impact, and you just have to choose as an investor which impact you want to be intentional about. So for us, we're very intentional about job creation, and we're very intentional about gender equality. Those are our kind of our two impact pillars, and really where we monitor our impact theory of change. So for us, every investment has to have a positive job creation screen, and every investment has to have a positive gender screen. So I spoke about the gender criteria that we focus on. So if I just put some kind of numbers to the impact that we've seen across our 10 portfolio companies, about 70% of our portfolio is female-led or female-founded. We're supporting today over 175,000 direct and indirect jobs. About 70% of those indirect jobs are women. In the last 12 months, we've been able to create over 700 direct jobs. We also track jobs for youth. So we're supporting about 1,500 jobs for people under the age of 35 years of age. About 44% of those jobs are held by women. And we are also very, very keen on showcasing gender diversity across not only the management team, but also the board, also the ownership of these businesses, as well as the distribution and value chains. So we're not doing this for charity. We're very intentional and focused on showcasing that as you focus on this gender diversity metrics across your portfolio value chain, it enhances profitability. And I think we've seen a lot of research now that shows that as you enhance gender diversity across the board, there is enhanced profitability, there is enhanced returns from gender diverse teams. So as we do this, we've seen the correlating impact on strong financial returns on the fund. So we think that impact and strong financial returns go hand in hand, especially in a market like Africa.
Thank you. And now moving on to you, Jasmine, an area you've done a lot of work on. Can you describe the importance of diversity and inclusion within the investment industry, and how diverse perspectives contribute to better decision making and outcomes? Jasmine, I think you're on mute.
Yes, thank you. Sure, it's about following the money, and if the capital allocation is biased at the upstream, when it trickles downstream eventually to founders, it also tends to be biased. And it's looking at the capital allocation diversity throughout the supply chain, from the fund of fund to the LP to the asset consultant to the GP and to the entrepreneur or business that is backed. And I think the more you have gender inclusion throughout the value chain, the more the ultimate beneficiaries of the capital allocation will be diverse. And what also needs to be fixed is that in Africa, we tend to have smaller size teams. So it's even more, there's more of an imperative to get the diversity of the team right. And it's fixing for the amount of these less than 10% of women in senior positions in private equity and venture capital globally. Only 6% of startups have secured more than $1 million of funding for indigenous founders. And that's just two stats. I'm sure there's an array of stats that can be quoted. And how a diverse team impacts allocation. It's also a diverse team has wider networks. For instance, 2 weeks ago, I was approached by a female executive in a large listed company about doing a management buyout, and I think she felt comfortable speaking to me as a female GP. And also diverse teams enhance the diverse decision making, and that's diversity across various metrics: nationality, ethnicity, age, educational background. and also diversity of thought. And diversity of thought comes from taking people of different socioeconomic backgrounds, people who've been to different types of schools, etc.
Thank you. And still with you, Jessamine, can you give some insight on the unique challenges and obstacles faced by women in the finance and investment sector in Africa, and how AIH Capital has overcome them?
I can think of two challenges. One with the historic ecosystem, which has a disproportionate representation by men. You tend to find men who have become senior in private equity funds, and they've created wealth for themselves in the form of carry and incentives. So it's easier then for those men to be able to break away and set up new funds, because they kind of have built up a buffer of reserves and a buffer of a reputation in the market. And for women fund managers, there's kind of it's a domino effect. So there's less of that legacy, and then also less reserves that have been built up from in having accumulated wealth in senior investment positions to then enable one to take the jump and set up a new private equity fund, or have the same level of reserves to keep one going once you do take the plunge. So that's one aspect of inequality, and then also seeing when you pitch, seeing less women on the allocator team. I didn't realize how that impacted me until I pitched last year, and there was a few women in the room on the allocator side, and I just naturally felt more confident, more relaxed. And then I realized that there is an impact on me pitching to a gender diverse team on the opposite side of the table. And as women, we lack that. And I think there also can be, even if it's subconscious, a male bias when the allocator only has as male representation, and they see they're being pitched to by a female fund. And how our fund has overcome it. So in our structure, we have a unique structure. Our parent company, African Women Chartered Accountants Investment Holdings, has 53 Black women shareholders who are mainly chartered accountants. So we have a broad-based structure in our fund manager, whereas most funds have 1 to 3 individuals who exclusively own the fund. And our fund is 100% female owned and managed. And when we go into meeting, our team is 100% women, and without saying anything, men whether it's companies we're pitching to, they get a bit nervous, and they start being apologetic and say, "Oh, we're so sorry, we don't have representation on our side." Or they'll say, "I'm so intimidated to be in a room full of women." So by bringing the critical mass of women, that's one way that we've overcome. And we tend to invest in male-dominated industries and sectors, but we have the strong financial experience and demonstrating that the acumen we have. And while we are a first-time fund, our parent company, African Women Chartered Accountants Investment Holdings, AIH, has a track record of 16 years. Myself and a co-founder, Cindy Kayana, have been part of AIH for over 16 years. So we worked as a team in building AIH. It has built up a portfolio of assets and have some successful exits. And so we piggyback off that, that track record, despite being a first-time fund.
Thank you, Jessamine. Now, Sheila, what would you describe as the value of value of collaboration and partnerships in fund management, including collaborations with local business, governments, and international organizations? So we've all seen your CV. Maybe you could shed some light.
Sure, thank you, Thembi. And I think this question is particularly relevant for me and for my business, because the strategies we're looking at, the two sort of asset management strategies we're looking at have been in partnership with other parties, right? So the first is around Special Opportunities Credit Fund that we've done in partnership with Petisa, and Petisa has been in the fund management space for a long time. And I will say part of, some of the things that Jasmine pointed to as challenges, when you get into partnership with someone who's been in the game for a long time, it sometimes helps address some of those challenges. So whether it's access to the gatekeepers, so again, for us as sort of trying to leverage our investment banking base to build an asset management business, of course, they're gatekeepers, and particularly gatekeepers for first-time fund managers. So getting into partnership with an existing fund manager has really been helpful in terms of them being able to open the door for all their LPs. So instead of trying to figure out how do I get to these potential LPs, that door is open through that partnership. And that's, I think, if you think about the time frame for fundraising and the time frame for fundraising for first-time fund managers, that's really, really been beneficial and helpful. And then also particularly on new strategies as well. So for us, it's like first-time fund manager and a new strategy. It's a bit easier to back, similar to what, again, Jasmine was saying earlier. People like to do what they've done before, what has been successful before. Convincing them to do something different can be a little bit difficult. And if you have people with you in the room that have done it before and done it, relatively well, or have the access or have proved themselves, then it becomes a little bit easier to have that conversation with a first-time fund manager. Then I think there's also an aspect about the learning curve, right? Again, if you're a first-time fund manager, even though you've been in finance, there's a learning curve. And sometimes, if I think about the entire process of managing a fund, the time might be better spent on building pipeline, doing that investor relationship management, but you still have to do other things, right? The back office functions are still critically important, particularly even in this space, whether it's impact, being able to articulate and measure your impact, as Adis was saying, or looking at ESG, all these things have become very important for LPs. So again, for us in our partnership, what's been great is that back office function is something that has already been a well-oiled machine with our partner, and you're able to leverage that from the beginning instead of having to build that in-house capacity, particularly when you're trying to be, cost sensitive at the start as well. I think that's particularly a good value addition. And then on the second strategy we've been working on, which has been around, so the Special Opportunities Fund is under ASARU, which is that partnership between Petisa and NISC. And the second strategy is in the creative space. It's called Anansia, and it's in partnership with the Hollywood-based studio. It's around backing Pan-African film. And there we've had to leverage now on this side the government partnership. So there's a lot of regulatory hurdles in terms of film creation and supporting Pan-African filmmakers and being able to actually back those productions. And so the partnerships with government, particularly on opportunities that are central to job creation. So we see, again, and this is for me within the East African context, I think for a while, most governments were backing on manufacturing, delivering for them on job creation. And unfortunately, that hasn't quite delivered in the way that it should. And this is also a discussion we have quite a lot at the government level with the body that I sit on. So looking at what is the low-hanging fruit in terms of what sectors can you actually support where you have a huge number of unemployed youth, but yet you need to create youth employment. So in particularly the creative sector, the partnership with government has been critically important because the structures are not in place. Even if I can say it's a little bit farther behind than a lot of sectors. So in terms of incentives, there's a lot of opportunities to produce and shoot film everywhere else in the world. Why should they come to Kenya? Why should they come to Rwanda? So those are the kinds of conversations you have to have with government, and to be able to unlock capital that's going to be able to support this creative industry. There are policies that need to be in place and incentives that need to be in place. And so we found with the partnership we're doing on that side in sort of the film space, we found that government partnership critically important, particularly when it comes to going through, all the requirements you would need from an incentive perspective to make places in East Africa competitive to shooting as, other global places.
Thanks, Sheila. And then I'm following on from that. So you kind of touched on it, but what should investors look to as emerging trends and opportunities, particularly for women fund managers in African markets that you're particularly excited about? And how are you positioning yourselves to capitalize on those trends?
Sure. So I think historically, if you look at how capital has been deployed on the African continent, particularly in the private equity space, VC and private equity, there's obviously a lot of equity financing and it has its place. I would say one of the feedback we've got a lot in this journey is that you take equity type risk, but you're getting debt type returns. So I think one asset class that's sort of been underappreciated and potentially under supported is debt, and debt outside of the banking sector. So of course, we have banks in all our countries. They're very specific in the way that they lend, and predominantly they look at sort of asset-based lending in East Africa, with some looking at cash flow-based lending. But there's an opportunity where you have a lot of creativity in terms of the debt space and being able to leverage debt instruments to serve particular gaps, right? Within the mezzanine space, businesses that are very cash rich but don't have assets, particularly in East Africa, have a very difficult time accessing debt financing, for example, right? And sometimes, again, for a lot of East African businesses, because that's a market I know, the idea around selling equity is still a difficult one, especially for family businesses in transition, because that idea of handing over ownership is still something that people are getting comfortable with. But there's a space where bank financing is not quite the right type of financing. But again, you need this sort of mezz or mezz-like financing, which I think a lot of businesses would be more open to. And if you look at the African continent, I think we have, maybe outside of South Africa, only 3 mezz funds, right? So there's an opportunity there. We particularly have been looking at special situations, and that's, some of the feedback we've gotten is the LPs and the investor base, predominantly the DFIs, really care about new jobs. But the argument we've been trying to put on the table is a job saved might be even better than a job created, right? So there's this idea around jobs that need to be saved, but at the same time, jobs that need to be created, but at the same time, especially in the post-COVID world, there's a lot of good businesses that have poor balance sheets. So the fundamental of their businesses are good, but because of all the legacy issues, the balance sheet is not right sized. So if the LPs can really focus on thinking about impact or expanding the view of impact to include sort of these, the ability to save existing jobs, especially when they're at risk, I think that's an interesting area of opportunity. And I also think, essentially, if we look at the balance of capital distribution, I see a lot of opportunity within the debt space, and that's what we've been looking at.
Thank you, Sheila. And now finally, Adeswa, why should investors allocate to emerging managers now? Specifically, what are the performance drivers of emerging managers versus their established counterparts?
Yeah, thank you for that question. So I would kind of put emerging managers under the bracket of kind of earlier stage managers, maybe in kind of between fund 1 to 3, that are managing kind of less than $100 million funds. And I would say that one of the benefits of investing in emerging managers is that they can tap into a more dynamic investment approach. They can tap into typically smaller, more nimble teams that can act quickly, that can capitalize on emerging trends, that can make decisions quickly. I also think that we have a big wall of capital in Africa and larger funds that are struggling to find, $50 million, $40 million, $20 million opportunities that they can invest in. So smaller funds that are investing in earlier stage businesses, that are providing them with that growth capital, that are able to institutionalize them, actually have more limited exit risk than some of the larger funds, because we're able to institutionalize these businesses, grow them, and make them very, very attractive to larger private equity firms that are looking for high quality pipeline. So, I believe that allocating to emerging managers right now gives investors the opportunity to access specialized expertise. We typically have more focus. We typically have more, specialized areas of focus. We can also benefit from more nimble and more decisive, I would say, decision making. first-time funds as well, and also emerging managing funds are also proven to outperform later stage funds. If you look at returns from Cambridge Associates, specifically research was done in the US, but I'm sure it's very, very applicable to here as well. And I think, you know, we just have more hunger, I would say, to prove and validate our investment strategies. And I think that's why you see very, very strong performance from emerging managers. But I think limited exit risk in the Africa context is one of the biggest benefits, because you have a wall of capital in larger funds that are really, really struggling to deploy $20 million, $30 million, $40 million deals at once. So it's really relying on the emerging managers to build that pipeline, and to, you know, bring out the champions of tomorrow that these larger funds can invest in.
Thank you to our panelists, and thank you for your presentations. Can we just remind the audience, please provide your questions in the Q&A chat box that you have, so that, you know, we can ask our panelists any burning questions. Maybe as we await, I might just ask the panelists some topical questions, because I do have some knowledge of their funds. But Jessamine, you've had quite an interesting time. South African elections have happened this weekend, and the first time we might have a coalition government, or at least the ANC has fallen below the 50% majority. How are we looking in terms of an outlook for yourselves? You know, I suppose this applies to most countries in the world, as this is the largest number of democratic elections we'll have in the world, but specifically to South Africa, which is right next door to my home. You're on mute, Jessamine.
We find ourselves in uncharted waters for our country, and there's different permutations that can play out, and all the political parties are now speaking to each other. So we hope that I think the best will be pragmatism in the parties speaking to each other, that they're willing to compromise, and we will know shortly in the next 2 weeks what is the outcome. And there's certain outcomes that I think are more favored by the business community, and we will, if we'll have to see how things play out. At least I think there hasn't been violence with the elections, because that also then it affects safety, and it affects the investment, the investment confidence. So unfortunately, we haven't had that. I think the elections have been free and fair, and our exchange rate has not moved much, because there's a lot of money in the short-term bond market from the international community, and that money can easily be pulled. So we'll watch the space with a lot of interest, a lot of dinner conversations at the moment.
Well, we all await. We do have a few questions from the chat box. The first one would be, what would be the key lessons you learned from your first fundraising process? I think I might just put that to all of you. We can start with Jessamine first.
Yes, I just feel like with hindsight, we put a lot of effort into the fundraising process, and I think we had to also put equal effort into the deal execution, because as you go along in the fundraising, the potential LPs want to know how much capital you deployed, and you actually need to focus on the capital deployment to have those stories to tell. So with the hindsight, I think we should balance the effort that we put into the fundraising. And also, I find we've had more support from the local community than the international community. So I'd also say focus more on the local community.
Okay, and Sheila, what would you say?
I would say that sometimes you'll get pressure to change your strategy. People have money for specific strategies, and a strategy that makes sense sometimes from an LP perspective. For me, it's been sticking to what you know really well and where you see the opportunity as somebody who sits on the, you're in the ground, you're looking at the transactions. In the business that I do, we're looking at transactions all the time. So knowing where those opportunities lie and being able to predominantly sort of validate the strategy you're backing and not try to sort of match a strategy to money. I'd say that's one thing, because sometimes when you also see funds underperforming, it's like the strategy, there was money for that particular strategy per se, but perhaps the strategy didn't make sense for that market. So maybe it's closer to sort of a product market fit. And then of course, it can be a long journey. So having that sort of patience as you go through that journey, or depending on the circumstances and what you're working on, knowing that it could potentially take quite a bit of time to get to your first close or your final close.
Thank you. Adesi, do you have any points to add?
Yeah, fundraising is definitely challenging as a first-time fund manager in Africa. And then when you're kind of raising smaller funds as well, it becomes quite challenging. So I think the best piece of advice I can give to aspiring fund managers is try to mobilize local capital. Go into your networks, reduce your minimum investment size if you have to, and also just to do deals. I think it becomes very different when you're talking to a pitch deck versus bringing an entrepreneur to an investor that you've invested in, who's talking about why your capital and strategy makes sense. So doing deals, even if you're just crowding people into SPVs and just getting those deals done, is so important, because it kind of changes the trajectory of your fundraising journey when you have deals to speak to. And you can do those first deals by mobilizing local capital. And that's what we were able to do, where we then had a portfolio of 5 companies, and then we were able to kind of get the attention of the likes of MasterCard Foundation, Visa Foundation, and so on. So I can't emphasize just starting and doing this.
Okay. And then we do have another question. So this is a comment and a question. Navigating the fundraising space is really tough as a first-time entrant. Would be grateful for any insight in this regard, which I think you've just spoken to. Are you happy for me to connect to you directly? So I think media advisors would like to answer the question. So I think the team can work to responding and maybe connecting the panelists with yourself, Akua. And then the next question is, how has impact investing acted as a catalyst for growth? Is there evidence you can share of sustainable economic development?
Sorry.
Yeah, that's right. Yeah, that's right.
No. I'm just going to talk to I think you're definitely going to get economic development when you have access to capital to SMEs. SMEs are typically the engine of most economies. They contribute to 90% of employment. So if you're able to provide SMEs with access to capital, you're able to spur industries, you're able to spur exports, you're able to spur jobs. And I think when you combine that as well with also investing with a gender lens the way that we do, where we are typically providing access to capital for female-led businesses that typically don't have traditional or alternative sources of capital, we're definitely spurring economic development. In our portfolio alone, we've generated, as I mentioned, we've created over 700 jobs. It's a small number in the midst of things, but with a country where unemployment is over 30%, these things are very, very meaningful. So yes, I think again, every investment has an impact. You just need to be intentional about what impact you want to drive, and be very intentional about when you're making those investments, tracking the kind of the impact that you're looking to make with that investment. But yes, I think in Africa, when you're investing in SMEs and smaller businesses, there is definitely sustainable economic development from every investment.
And then I think this one is for you, Sheila. I am an intermediary business based in Washington, D.C. with teams in Kenya and Rwanda. We train women SMEs to export and trade and grow. We create pipelines for funding and growth. What state of, I think, revenue and growth will your funds meet or have a conversation? Okay.
I don't quite get the last part of the question, but I mean, for the Special Opportunities Fund, it's we're targeting ticket sizes between $8 to $15 million, thereabout. And for the creatives industry, it's much smaller. Even the 250, 100,000, like it's very small ticket sizes. Maybe max would be $1 million if we even get to that.
Okay. Thank you. I think we have time for one last question. Just for the international investors that are listening to this webinar, what would you like to share with them about key investment opportunities in Africa that would pique their interest and add value to their portfolios?
I could give a couple of insights. So I think for the international investors, ignore Africa at your peril, really. If you're building a global diversified investment portfolio, you have to be allocating to Africa because Africa is the last frontier for growth. There are going to be 200 million Africans living in cities over the next decade. There's a population that is predominantly young, where 1.2 billion, well, actually now 1.3 billion people will have increasing disposable income in the next 30 to 50 years. Nigeria alone will be the third most populous country in the world by 2050. So if you're investing in other parts of the world, investing in Africa also provides very, very low correlation with Western markets. So it provides kind of true diversification in your portfolios. And this growing, rapidly urbanizing population is going to need access to goods and services. And there's very, very low per capita usage of most goods and services across Africa. We have low healthcare penetration. We have low smartphone penetration. There's just so much to do across every industry. So I think investing in that young population that are going to be consuming goods and services for a very, very long period, over the next 30 to 50 years, we think is a very attractive investment opportunity. So if you're looking for alpha, if you're looking for enhanced returns, if you're looking for uncorrelated returns as well to your existing, Western portfolios, then I think you ignore Africa at your peril, really.
And I'll add to that COVID has shown the disruption in global supply chains and the ripple effect that's caused, and where there was a reliance global supply chains from the East and China. I think it's good to diversify the supply chains because it builds more resilience when you do have any black swan events. And also for carbon credit trading, where there are companies in the Western world where who are not using sustainable sources of energy. There are lots of carbon credit trading opportunities from Africa because there's a lot of arable land and land that could be developed into sustainable agriculture and forestry projects.
And one thing I would add is to stop thinking about Africa as one place, even when it comes to the investment strategies. So as you can see, we have West African representation, South African representation, East African representation. What a small cap, mid cap, and large cap deal looks in those markets is very different. And what I often struggle with is sort of that blanket approach to doing a deal all across the region. The dynamics are just very different. So having strategies that are also a little bit more granular in terms of, or deploying in a more granular sense than kind of having one Pan-African strategy that is meant to meet the same sort of metrics and return profiles all across. Because again, and rethinking risk sort of pricing or risk, the risk premium, because I think it's there's a lot more perception than is reality. And so working with local partners that can understand risk and help sort of sensitize risk models, I think would really help, because those are the two areas where I feel like everything is sort of blanketed all across the continent, and it's actually very different.
Thank you, ladies. And just one last question. How does each fund incorporate renewable or sustainable investments criteria within focus towards women-led companies? Whoever wants to go first. Sheila, maybe.
Sorry, can you repeat the question? Is it what's the criteria for investing in women-owned businesses?
So it's asking how do you incorporate? It's almost asking how do you incorporate ESG or criteria within the focus towards women-led companies?
I think it's almost so for most businesses we look at, they might not yet be at the ESG level that you need them to be at, even for the fund, but you grow with them. And there's a lot of sort of in the ESG expert space, there are a lot of things you look at. You know, it might not be beyond, let's say, women in the top management. It could be women in the supply chain. It could be who you're impacting from a per dollar perspective. There's many different ways to look at it. But I think what I've seen so far is that most of the businesses might not be where you need them to be as a fund, but there's opportunity to grow with them to get them to where they need to be. And so it becomes a post-investment sort of tracking than a pre-investment decision.
Would anyone like to add to that?
Yeah, so with our fund, we had the IFC help capacity build our ESG management information system, where we look at ESG across the deal execution value chain, from the initial screening to what goes into our IC paper to the ESG on due diligence. And if we're investing in a manufacturing company, then we get a specialized ESG service provider to do the ESG due diligence. And then what goes into legal, some ESG clauses around the portfolio companies having a social and ethics or ESG subcommittee. And then post-portfolio management, we have quarterly reports that the portfolio company has to complete. And we've tried to make there's also balance. You don't want to just lump it on a company where they just see it as onerous and admin. So asking just a few questions in the post-investment quarterly questionnaire. And we will try, and because we are sector agnostic, but to the extent that we invest in the industrial sector, to look over time if the company can show it's reducing its carbon footprint, so almost a gentle nudging of the portfolio company in that direction. And that will apply to whether we're investing in a male-dominated industry or company or a female portfolio company.
Thank you. I think that's it for today. I think we've exhausted the questions. We will hand over to Yebsira to help us close off this meeting. Thank you very much, ladies. This was quite engaging.
Thank you. Thank you all so much. I would like to thank our moderator, Thembi, our panelists from East, West, and South Africa. And thank you to our audience from all around the world for attending this engaging and quite informative and conversation and webinar. My name is Yebsira Zode. I am an associate director at Mida Advisors. And just a little bit about us. Mida Advisors is a global advisory firm specializing in facilitating institutional investments and trade in Africa and other emerging markets. Since 2023, Mida Advisors has announced and closed up to amounting to $2 billion in housing finance commitments in Africa with global investors and development partners, and more than $2 billion as well in other projects and in Africa and emerging markets. The firm is headquartered in Washington, D.C., where we're based, and also have offices in Kenya and in South Africa. And in partnership with Standard Bank, we're really committed to continuing this conversation and support women's active participation in Africa's financial services industry. I would like to highlight the significance of women fund of funds like African Women Impact Fund that is led by Standard Bank Group and Rescura with support from Mida that continue to support and encourage investments in women. Again, I would like to thank you all for participating in this webinar. We will share the panelists' bio and information after the webinar, and if you would like to connect with them, we will share their information as well. Please feel free to reach out to our team at Mida Advisors and follow us on LinkedIn to get updates on the various programs that we do on women and emerging markets and very exciting transactions that we work on. And also to keep an eye out for the next series of the webinar, the third, that we're going to do in a few weeks. So please keep an eye out, and we look forward to your participation again. And thank you so much for asking questions, for being present, and thank you our panelists again, and for everyone supporting this webinar. Thank you all. Have a wonderful day and evening.
Thank you.
Thank you. Bye-bye.
Thank you.
Thanks, everybody. Bye.